What's up, traders? Welcome back to Trading Infos, where you get genuine and real trading education. If you're new here, my name is Infos, and on this channel, I help traders simplify the markets, improve their analysis, and become more consistent in their trading journey. Multiple time frame analysis. Some call it multiple time frame analysis. Some call it multiple time frame trading. Some call it top-down analysis. Some call it price action. All these names, they mean the same thing. Don't get confused. When you hear multiple time frame analysis, you hear some other traders saying multiple time frame trading, you hear top-down analysis, or you hear price action. They all mean the same thing. Do not get confused. Okay, they mean the same thing. So what is multiple time frame analysis? Multiple time frame analysis is the process of analyzing the market, analyzing the same market using different time frames before taking a trade. Let's say you're analyzing GBP USD or Euro USD and you use different time frames before taking a trade. That is simply multiple time frame analysis. Instead of depending or relying on just one time frame alone, we use higher time frames to determine the overall direction of the market and the lower time frames to find precise entries. That is, use the higher time frames like the daily time frame or the 4-hour time frame to get the market direction, what we call the bias. Then we narrow down, we fall down, go down to the 15 minutes time frame or the 5 minutes time frame to take our entries. That is multiple time frame analysis. You get direction on the 4-hour or on the daily, then you come down to the 15 minutes or the 5 minutes and take your entry. That is all about multiple time frame analysis or top-down analysis. Think of it like using Google Maps. Before driving to a destination, you first look at the entire route, then you zoom into the exact street and turns. Maybe you want to go from A to B. Before you drive from A to B and you are using your Google Maps, you first of all look at the entire route, then you zoom in to see the exact street and turns. Trading works the same way. The higher time frame shows you the bigger picture. The higher time frames like the 4-hour and the daily time frames, they show you the bigger picture. They tell you what the institutions are doing, if they are buying or they are selling. Then the lower time frames shows you the details. Many traders lose because they focus only on the lower time frames and ignore the overall market direction. It's the truth. If you only focus on the 5 minutes or the 15 minutes, you focus on the 5 minutes or the 15 minutes, you will lose because the 5 minutes may be bullish while the daily or the 4-hour time frames is bearish. And if you enter a trade when the bigger picture, when the higher time frame is bearish and you are taking a buy trade, you will surely lose that trade because you are trading against the market direction. So the bigger time frame gives you direction and you lower it down to the smaller time frame to enter. There are many ways to trade the forex market. So many ways. Some people use indicators to trade the forex market. Some people use robots. Some people use just pure price action, which is also called multiple time frame trading or multiple time frame analysis or top-down analysis. It is just going to the higher time frame like the monthly or the weekly or the daily or the 4-hourly time frame to see the bigger picture, to see what the institutions are doing, to see the market trend. Is it an uptrend or is it a downtrend? Then you narrow it down to the smaller time frames like the 15 minutes time frame, like the 5 minute time frame, like the 1 minute time frames for a better entry. That is all. What I'm saying is you use the daily time frame, or the 4-hour time frame, or even the 1-hour time frame to get your direction. Come down to the 15 minutes or 5 minutes or 1 minute to take your entry. You use this to get direction, and you use these very time frames to take your entries. You can use MT4 or MT5 for this very purpose. Why is multiple time frame analysis important? Let me ask you a question. Have you ever entered a perfect looking buy trade on the 5 minutes only for the market to immediately reverse and stop you out? Or maybe you've taken a sell trade that looked amazing only for price to shoot up against you. The reason this happens most of the time, you are trading against the higher time frame. You don't trade against the higher time frame, against the trend, and the trend is always determined on the higher time frame, like the daily, the monthly, or the 4-hourly. This is why professional traders always analyze multiple time frame analysis before entering a trade. They always do top-down analysis before entering any trade. It is the best way to approach trading. So let's talk about the 3 time frame approach. This consists of 1, the higher time frame, 2, the medium time frame, 3, the entry time frame. The higher time frame, like the daily, the 4-hourly, or you can even use the 1 hour if you are a scalper. If you are scalping, scalpers use 1 hour to get direction. Then they go to the 15 minutes to plot their zones, to mark their key levels. Then they fall down to the 1 minute to take their entries. I personally use the daily or the 4-hourly time frame as my higher time frame to get my direction, my daily bias. Then I fall down to the intermediate time frame. Is the 15 minutes. I don't mark my key levels on the 1 hour. I mark key levels on the 15 minutes. That's the way I trade, and I've been very profitable. So I use the M15 as my intermediate time frame. This is where I mark my key levels, my areas of interest or points of interest. Then I use the 5 minutes or the 1 minute for my entry. I go down to the 1 minute or the 5 minutes and I take my entry. But as a beginner, stay away from the 1 minute time frame. It is too noisy, a lot is going on, so you need a lot of experience before you can trade on the 1 minute time frame. So stay away from it for now. So what I do is this: I give each time frame a specific purpose. Each time frame has a specific purpose. Whether I'm using the 4-hourly or the daily, I give it a specific purpose. The first thing I do is I move to the higher time frame. I prefer using the daily. I use the daily more than the 4-hourly, but you can still use the 4-hour time frame in your own trading. But me, I prefer using the daily time frame to get my direction. For example, on the daily chart or the 4-hourly chart, the purpose of this time frame is to determine the overall market direction. So this gives you direction. This very time frame gives you direction. That is all about it. That is what I do here. I do nothing but just to know if the market is in an uptrend. I ask myself on this very time frame, is the market bullish, or is the market bearish, or is the market ranging, that is consolidating? Is it going up, or is it coming down, or is it ranging? That is what is called consolidation. It's just moving sideways, creating equal highs and equal lows. So look for higher highs and higher lows in an uptrend. You know, higher highs and higher lows, they are the characteristics feature of an uptrend. Then lower lows and lower highs are the characteristics feature of a downtrend. Never skip this process. You get direction first. You don't trade against it. Trend is your foundation. Without it, you will be trading blindly. So you must know the trend. The trend is the direction. Are buyers in control of the market at that moment? Are sellers in control of the market at that moment? Or is the market consolidating? Is it just ranging, creating equal highs and equal lows? You must know that first. After I have gotten my direction on my daily or on my 4-hourly time frame, then the next thing I do, I start marking my key levels, my areas of interest, and I use the 1 hour. You can use the 1 hour or the 15-minute time frame for this purpose, for AOI. AOI means areas of interest. Once I know the trend, I begin marking important areas on my intermediate time frame, on this my 1 hour time frame or 15 minutes time frame. I will start marking important areas. These areas could be your support levels, could be your resistance level, could be your supply zone, could be your demand zone, could be a fair value gap, and it could be liquidity areas. So you start marking them. These are locations where price is likely to react. Once it gets there, it's likely to react. Either it will continue going up or it will reverse and come down. So these are locations where price is likely to react. Price does not move randomly. It moves between important levels. It's either it's moving from demand to supply, or it's moving from the premium to the discount, or it's moving from resistance down to support, or from support back to resistance, because these are important areas. This medium time frame helps to identify where these levels are located. We will go into practicals very soon so that you will see what I mean. Now, when I have gotten my direction on the daily time frame or on the 4-hourly time frame, and I have marked my key levels either on the 1 hour or on the 15 minutes time frame, then the next thing I do, I drop down to the 5 minutes time frame or the 1 minute time frame, and I take my entries. And before I take my entries, there is something I do. You must wait for price to mitigate, to come into all those zones, all those areas of interest. Price must tap into those areas of interest on your 1 hour or your 15 minutes. Price must come into that place, tap into it before you come here, before you come to the 5 minutes time frame or the 1 minute time frame to look for your entries. You must wait. So after I have known the direction on the higher time frame, I will drop down to the 1 hour or the 15 minutes, but I use the 15 minutes for my own trading. This is where I mark my key levels, my support, my demand, my supply areas, my fair value gap, and my liquidity zones. I do that on the 15 minutes. These are called key levels. This is where I mark my key levels. And after I mark these key levels on these very time frames, what I do, I wait. This is where patience becomes important. You do nothing, because after marking these levels, sometimes price is still far away from entering these zones. So you wait for price to mitigate this very zone. This is where patience becomes very important. Most traders see movement and immediately jump into the market. I don't do that. I wait for price to come to me. Let's say your zone is somewhere here. Your zone is here and price is still around this place coming to your zone. Some traders will just jump and enter because they are seeing this move, fear of missing out on this move. Meanwhile, their zone is here. Their supply zone is here. They will not wait. They will just enter. And meanwhile, the market may decide to temporarily reverse, hit their stop that they have placed here, because if you are entering the market when it is going up, SL will be down here and your TP will be up here, your take profit. So when this market is moving and you refuse to wait, to exercise patience, what will happen is that the market may reverse temporarily, because it does not just move up. It will do what? Breathe out, breathe in, breathe out, breathe in, breathe out. That's the way the market moves. So when they enter, the moment they place their order, their buy order, the market will do what? Temporarily reverse, take out their stop, then continue in the initial direction. That's why patience is required. You must wait for this price to come into your point of interest. Once it taps into it, then you fall down to your entry time frame. The market will always provide opportunities, so don't develop any fear of missing out. Forget all those FOMO. The market will always come to you. It will always give you an entry opportunity. Once price reaches my area of interest, I drop to this time frame. I drop to the 5 minutes or the 1 minute, but I use the 5 minutes most of the time. It's maybe when I want to scalp. Now I begin to look for entry confirmation. Some of the entry confirmations I use BOS as one of my entry confirmation. I use market shift. Market structure shift, which is also called change of character, one of my entry confirmation. I use the engulfing bar, the bullish engulfing bar as one, and I also use the bearish engulfing bar as also my confirmation. Or I wait to see a very strong rejection candle. Take for example, the market was moving in an uptrend this way, and it gets to this point. I will wait to see is either a pin bar. If I see a pin bar or a shooting star, then I know that this market is about to reverse, because as it's printing this way, it will be printing the bullish candles and some bearish candles, but the bullish candles will be more. Then if it gets to this peak and I see a strong bearish candle, maybe a Marabuso, I know, or I see Harami, I know that these are reversal patterns. So I start getting prepared, because I know sellers are about to take over, to take control of the market. So I wait, and this area will be one of my points of interest, which will be my supply zone. So what do I do on this very time frame? I wait. Once I see all this confirmation, this is where I execute my trade. I do what? I enter a sell trade. I take my profit at the next liquidity area or the next demand zone. Then I place my SL, my stop loss, just above the supply zone. I just go for 1:2. I told you before in my previous video, I always stick to 1:2. It's just in most rare cases I go for 1:3. It's not bad if you want to go do 1:3. It's okay, that's fine. But I always ask people, which one is more realistic, 1:2 or 1:3? 1:2 is more realistic. Now I will take you to the chart. Let's do some chart work. So for this example, we are going to use the Euro US dollar. We are going to start on the daily time frame, because I told you I use 3 time frames. I use the daily to get my direction, then I fall down to the 15 minutes chart to plot my key levels, to mark my key levels and draw my zones. Then I go to the 5 minutes or the 1 minute to take my entry. So we'll be using 3 time frames for this purpose. First thing you do, you identify your break of structure. You remember our market structure mapping process. The market broke structure over here to the upside, and this becomes our low, and this becomes our high. The market pulled down and broke structure to the downside here, so we'll have a BOS here. Let me just put BOS. This is the BOS over here. So the market pushed down, broke structure to the downside, forming a new high and forming a new low. It pushed up, it could not break past this level. It pushed down, it could not break past this level also. So on the daily time frame, the market is bearish, is in a downtrend. Why? Because our last change of character, the market shifted here. Our last change of character was a bearish change of character, so the market is bearish on the daily time frame. GBP USD is bearish on the daily time frame. This is our daily swing high. and this is our daily swing low. So the next thing we do, we fall to the 15 minutes time frame. First thing I have to do is to know if the 15 minutes time frame is bullish or is bearish. You don't just jump and start drawing or marking your zones on the 15 minutes time frame. First thing you want to determine is the 15 minutes time frame bullish or is it bearish, because the daily time frame has already given us our daily bias, the direction that all we should be looking for is to sell and not to buy, because the market is bearish on the daily time frame. So when we come to this 15 minutes time frame, you want to first of all see if it is aligning, if it is in agreement with the daily time frame. But if it is not, you have to wait. So let's see if it is in agreement with the daily time frame. You can see we have a break of structure over here to the upside. Let me change the color of this line to red, so that when we see red, we know that red represents the break of structure on the 15 minutes. So I'll call it M15 BOS. Market broke structure to the upside over here. Let me increase it so that you will see it. So the market broke structure to the upside over here. We are looking for a close down. We have the close down here, so this becomes our low and this becomes our high. The market pushed down with so much momentum and broke structure to the downside over here. This is where we have the change of character or the market shift on the 15 minutes time frame. This is the M15 change of character at this very point. So we are looking for a close up. This is where we have our close up. This is our swing low. Our swing high remains the same, so we increase it. So currently the market is ranging. You can see it moves down, broke structure, but it's currently ranging, and we are in a bearish scenario because the last change of character is in the bearish direction. That's a bearish change of character. So the M15 is bearish and the daily time frame is bearish, so they are in agreement. So next thing you have to do, you have to plot your key levels. What do? You come here, I can see a supply zone here. I draw my level here. Then I can also see a demand zone here.